Good afternoon, good day, and good morning. Good evening, I suppose, as well, to everyone who's attending. I thank you for taking the time out to listen to me. It is always an honor to have people attend to what you say. I'd like to thank FX Street, as always, Maud Gilson and company, who I believe we have the honor of being with us today, for the ability to perform these webinars. Today's topic is Australia. I titled it The Lucky Currency, the Australian Dollar. That, of course, is a take. Let me put something on the screen for everybody. And let me also say, as I do in every webinar, that I'll turn the volume up. Hold on. Okay, that should help a little bit. Hold on. I hope that's a little better. I'd like to encourage anyone who has any questions on any topic whatsoever during this webinar, please just type them into the chat box, and I'll be glad to take some time from what I'm talking about and answer any questions. Also, if there are any issues with being able to view the webinar, we are starting on time today, which my title, of course, The Lucky Country, for the Lucky Currency, comes from a book written in 1964 by an Australian. The man was Donald Horne. By the way, if anyone has ever read, is looking for probably the best book about Australia history and Australia in general, certainly that I've ever come across. The man just died within the past year or so. It's a book called The Fatal Shore by Robert Hughes. I cannot imagine a better history or introduction to Australia, or really a book about any country, any better than that particular book. It is incredibly enjoyable, it's incredibly informative, and it's absolutely fascinating. It actually creates an image in your mind as you read it about what it was like to come to, as Europeans in the late 18th century, to encounter that land and its culture and its people. It's absolutely fascinating. By the way, Australia was not discovered, in case anyone has any questions, by James Cook or at all. The author's name is Robert Hughes. The book is The Fatal Shore. It is literally one of the best books I've ever read, and I mean that. Certainly in history and cultural history. The Australian continent, or the subcontinent, was not discovered by Captain James Cook in the latter part of the 18th century, nor by Europeans in that century. It was actually visited in the 17th century by a number of Dutch explorers, none of whom colonized the place, and there have been a number of claims that Australia was actually visited by Chinese fleets in the early part of the 15th century, the 1400s. That is unproven, but it is a fascinating topic, and I think you can find it. But that is not our topic today. Although I have visited Australia a number of times when I lived in Asia, and I've always found it a very congenial place to visit, and a very easy place for an English speaker to drop in and feel very much at home, and an American. The title of the book was The Lucky Country. Now, Australians have taken to referring themselves as the lucky country, and you hear it a lot in the press, as a compliment. But in fact, the book did not mean it as such. And I'll read you the quote from the author here. He said, "When I invented the phrase in 1964 to describe Australia, I said, quote, Australia is a lucky country run by second-rate people who share its luck. I didn't mean that it had a lot of material resources. I had in mind the idea of Australia as a British-derived society whose prosperity in the great age of manufacturing, the 19th century, of course, came from the luck of its historical origins. It has been taken by Australians and also by other people around the world, to mean a country rather uniquely blessed with a, we have to peace to the Aborigines since they were there first, with a dominant and largely uniform culture, great resources, great space, and a stable political system. That is what has been taken to mean now. And a lot of that is true. There is a recent poll out, and I just ran across this when I put up Lucky Country in, and the Australians have taken to refer to themselves as a lucky country as well. There's a recent poll out, the CNN, I think, is it the CNN poll? No, it's actually the OEC, Organization for Economic Cooperation and Development, does a poll on. Yes, the people are extremely friendly. I've had a very good time the times I've gone to Sydney and Melbourne. I used to go there moderately regularly when I was based in Singapore. They were part of my business. But anyway, CNN has just done a poll recently. CNN reported on a poll done by the Organization of Economic Cooperation and Development, where they poll people and they rate their countries. And the Australians, for I think the third time in a row, have rated themselves the happiest country. Now, they don't actually say who's the happiest country. Of course, they ask a number of criteria, and whoever scores highest on these criteria gets to be the happy country. So Australia is there again. Now, let us look at our topic. Now, we really have two topics here, or two interrelated topics here. One, of course, is the one that we're all concerned with prima facie, and that is trading currencies, trading the Australian dollar. And whether or not Australia is to be classified, although I'm not sure it matters very much, a commodity currency on a emerging markets currency is clearly not an emerging market. But the classifications don't really matter very much. Yes, Australia was settled by the British as a penal colony. That is true. I think that's probably the derivation of Mr. Hughes' title, The Fatal Shore. An absolutely fascinating topic. 1780 something, I think, is when the first fleet got there. I'm not exactly sure. Maybe 1788, something like that. I'm not 100% sure. There are really only two countries in the world, the United States being the other one, New Zealand too, let me not forget New Zealand, that were settled by Westerners of a much higher technological level. Actually, that's true for Australia. By the time that the British got to Australia in the 1780s, their technology was vastly superior to the Aborigines. That's not quite so much true in the United States, where the first settlers got here in the early 1600s. And although they did have metal, and originally the Indians did not, and they had gunpowder, and originally the Indians did not, the technological level was not as did not favor the settlers quite as much as people think. But be that as it may, what we're interested as traders is what drives currencies. Take a look at the Australian dollar here. I have some markings of QE on here. We're going to talk about that in a minute. Let's take a look at a currency that would be much easier to classify as an emerging market currency. And take a look at the difference in the currencies. Okay, this is the Indian rupee. You can see the enormous fall in the rupee against the dollar. This is the Brazilian real. Same thing. I actually saw a news item this morning that the authorities in India are attempting to, let's put the Aussie back up there, and you can see the much greater volatility in those currencies, are attempting to curb some of the, as they call them, speculative excess in the Indian currency through, they're not quite capital controls, but controls on overnight positioning. This is very reminiscent, of course, of the ERM crisis in the mid-90s, before the euro, when the Europeans attempted to, this is, George Soros' glory days, attempted to control speculation in many of the smaller currencies in Europe, the Belgian franc, among others, by imposing overnight controls that interest rates that put on huge costs for someone holding an overnight position. Just as a brief explanation, the way that works, when you do a spot trade, your settlement is 2 days. Nobody settles. None of us take currencies, but the system and the banking apparatus behind it is designed to take settlement. That means if you buy the Brazilian real, the financial logic behind it is you want to take delivery in 2 days. That means you want real in your account. You have to settle some trade debt. So in 2 days, that position has to be rolled over. All rolls charge or benefit the owner of the currency depending on the difference in the interest rates. So if whichever currency has the higher interest rate gets paid. So if you buy real, and I think the Brazilian, what is the Brazilian central bank right now? Right, let's take a look. It's 8%. So if you buy the real and it's in your account, and U.S. and it's against the dollar, well, the dollar is paying 0.25, actually less. The real is paying 8%. So holding that position overnight, you would get paid. And the reason for that, and the other side of that is, what's going on in the real now, of course, is a shorting of the real. This is against the dollar. So the dollar used to buy 2, it now buys 2.25. That would be fourth and eighth change in that period. So if you're shorting the real, and this does matter, that's why I'm bringing this up. If you're shorting the real, that means you're long the dollar. You're long the dollar against the real. You're long the weaker paying currency. The dollar pays 0.25 if you take the central bank rate. The real pays 8%. That means you have to pay to maintain that position every night. And if we look at the Brazil central bank rate, we can see what they've done. The world economy is at best questionable. The Brazilian economy has slowed down quite a bit. But the Brazilian central bank is raising rates. Why would they be doing that? Because they're attempting to make it more costly for people to speculate against the currency. Let's take a look at the Indian base rate. The Indians have not taken that move yet, but they may. What they were attempting to do, and I have the news story right here, is what they're doing is they're tightening up margin requirements. Sound familiar? The Chinese did something similar as well. The difference on these currencies, this is the Australian dollar. The Australians have done nothing like that. In fact, if you look at Australian central bank rates, where are my Australian central bank rates? RBA cash rate, 5 years, right here. They've been lowering rates since 2012, very gradually, but they have been. So let's take a look at the Aussie again. So the difference between these currencies and what's driving them is what we're trying to get at here. Now, we have a large difference in the size of the economies. But for me, that's not the real driver behind the valuation changes in these currencies. Let's step back a bit. Let's take a look at, and why don't we just look at the, let's see one here. Okay. What I'm trying to look at here, and what we're going to take a little bit of do in detail right now, are the market motivating factors. What's got the markets moving into these particular currencies or away from these particular currencies? Okay? Let's start with the major, even before we go deal with interest rates, because we all know that interest rates are have the greatest correlation to movements in currency markets. So we could, and in a normal world, look at interest rates. But in the United States, at any rate, and the United States Fed has the greatest impact as the world's largest economy, and the dollar being basically the world's reserve currency. I remember when, back in 2008, when the Fed started its quantitative easing and its reducing rates, which was actually started in 2007, there was lots of idle talk, idle articles, idle speculation on the end of the dollar as the world reserve currency. It was spoken about a lot, read about a lot. I used to get asked about that when I would make various appearances, and my opinion on that had never really changed, and it doesn't now. And the question is, replaced with what? Just as all decisions in currencies are binary, it's not simply what the Fed is doing, it's what the Fed is doing and what other central banks are doing. Who's latest to the party? It's not simply what the U.S. economy is doing, it's what the U.S. economy is doing in comparison to its other trading partners and its other currency partners. That's a binary decision. And it's exactly the same with the question of a world reserve currency. Where do you go? What would replace the dollar? There never has been, there isn't up until now, a viable, much as I don't like that word, a acceptable alternative. The larger economic bloc in the world, which is actually the largest, is actually the European Union. Its currency, although not shared by all members of the Union, is the euro. But the euro does not issue euro bonds. It issues national bonds denominated in euros. And that's a very different prospect because any national economy, the German, the French, the Italian, the Spanish, the Belgian, has a much smaller need and a much smaller treasury market or government bond market than does the U.S. So you're not comparing the bond market of even the EMU, the Euro countries, to the United States. You're comparing individual bond markets to individual national markets of the United States. And there the comparison breaks down because the size and ease and liquidity is what reserve currencies are looking for. As far as other alternatives, the yuan is not a freely traded currency. The Chinese credit markets are highly controlled, and there's really no equivalence between the openness of the Western banking system and the Chinese banking system. The Chinese banking system is essentially a state-run system. I think I've mentioned before that when I was in graduate school, I wrote a paper on the Chinese banking system. And it was not easy. This is the late 80s. And it was not easy then to find any reliable information. And in fact, most of the Chinese banking system seemed to be at the time nothing more than sort of a game of fantasy accounting. You just change what your statistics are in your books and thereby the problem goes away. I think it's probably much different now. Nonetheless, the Chinese banking system is largely a creature of the state. And the state uses it to supply credit or to withdraw credit from the system, and it funds much of the state-run sector, which is still huge and inefficient in China through the banking system. Now, China is another fascinating topic, but we're not going to get on that today, except as it affects Australia. And so I will talk about that in a minute. Now, let's look at these currencies. And what I'm trying to do is compare the Australian dollar, which, of course, we can talk about in isolation, but I think it's more instructive to talk about these currencies in comparison to others. In this case, I am going to compare them not to other industrial countries, but to some of the emerging markets countries, primarily the Indian rupee and the Indian economy, and the Brazil real and the real economy. The first comparison I'm going to make is on these currencies and their reaction to quantitative easing. This is a chart of the Australian dollar over the past 5 years since the financial crisis. By the way, we have all lived for the past 5 years in probably definitely the most fascinating economic and social period since the Great Depression. Plays out differently, but the principles are very similar. Remember what happened, consider the results of the Great Depression. One of the results of the Great Depression was the Second World War. Economic catastrophe tends to produce violent results. Now, we look around 5 years later, and we say, well, where are the economic results? It would be my contention that the turmoil throughout the Middle East, or at least through the Maghreb and into Egypt, which we're looking at now, has been a direct result of the economic turmoil created by the Great Recession. It plays out differently, but the principles are the same. But then again, we're not going to get on some of my favorite topics here. So, one question, do you think the world economy will deteriorate further? Yes, I do. The primary reason is because if you look around for growth, what's happening with currencies mirrors what's happening with world economies. Everyone is attempting to do the same thing, to create the economic structures that will create wealth for their people. That's what everybody's trying to do, some much more successfully than others. But in doing so, how do you create wealth? Well, you create factories, services that other people buy. There is it seems to me, the factories get created first. The world is, in many cases, attempting to do things very quickly under the pressure, perhaps you could say, of awareness created by everyone being able to tune into the internet, even more so than before. If you want to create expectations, give somebody an iPhone. Give somebody access to the internet. That creates an enormous desire for the life depicted in all of those places, some of which is real. I think more than anything else, in Egypt now, the frustration has been the inability of Morsi's government to provide economic growth, regardless of whether the expectations were realistic. That's not the point. But these expectations can be very, very dangerous when they are not fulfilled, or people don't get a sense that they are along the way to being fulfilled. Anyway, that's another topic. So here we have the basic reason is because there are two reasons. One, the U.S. is the world's biggest economy, but even more than that, the U.S. financial system dominates the world. The dollar dominates the world. If there is a world monetary policy, it's the policy of the Federal Reserve. And that's one of the reasons that if you look at all of these currencies, let's look at some. I don't have many currencies up here. But one thing we've seen in this whole period here, come on, computer, this right here, the fall into 2008, sheer panic, everybody wanted dollars. The moving away, partially recovery, the world was not going to end. But also, don't forget, the Fed, if you look at Fed, let's look at the Fed funds rate. The Fed began reducing rates in late 2007. The fall in, or the gain in the dollar in the latter part of 2008 was a panic reaction. The fall in the dollar since then has been the natural reaction to both the excessive strength of the dollar based on psychology, but also the weak U.S. interest rates. A weakening dollar against all other currencies does what? Well, it creates a more favorable terms of trade for the United States. Again, and I've said this many times, central banks serve their national economies. They do not serve the international economy. That will always be true as long as nations, as long as the human species and its culture are organized into nations as the largest unit. Forgive me on my comments or the implication here for the UN, but the nation state is still the dominant force. No one's even close in world affairs. I remember I took a very elaborate international affairs course, international law course when I was in graduate school with a very, very famous international law professor. And international law is fascinating as an intellectual endeavor. It is largely without effect in the real world. Anytime you hear international law being quoted in reference to a political dispute on an international level, you know that it's being quoted because somebody doesn't have any power. One side of that dispute is powerless. And so the last resort in international affairs is always a recourse to international law. States operate on a monopoly of force. That's the basic unit of functionality in any state that has ever existed on any level, from a tribe all the way up to an empire. It monopolizes force as best it can. And until there is a monopoly of force on the international level, there never will really be any international law. But be that as it may, let us look at the Australian dollar. I'll get to that question in a minute. It's very difficult to tell how much anything. I can't possibly tell how much you'll get a devaluation of wages, but you are getting in the United States a much milder version of what is going on in Greece. In Greece and in some of the other countries. Because they are participating in a currency which which is much more, it's not entirely inflexible, but which is much less flexible than, say, the drachma would have been, because if the Greece still had the drachma right now, the drachma would have, devalued by half. Greek exports, such as they are, would have gone down in price, and people would buy more of them, and people would vacation in Greece, and there would be more money flowing into Greece for the Greeks. That can't happen anymore. So the only way to devalue is an internal devaluation, meaning wages, meaning the living expenses in Greece. So in order for Greek products to become competitive, they have to go down in euro terms. But if the euro isn't going down, and it has gone down a bit, then the number of euros per Greek unit of export has to go down. The only way to do that is if Greek workers are paid less. And that's what's happening. You see some of that in the United States as well. If you look, it's not the only thing that's going on, of course, but if you look at the wage growth in the United States has been essentially stagnant for the past 5 years. That's also a competitive reduction in the cost of U.S. products. It's a good question as to how much the dollar is overvalued. It's not one I can actually answer. The dollar, has cross currents which have nothing to do with valuation. You look at 2008, that valuation, that purchase of dollars and dollar assets had nothing to do with any value inherent in the dollar. It simply had to do with fear. But once you get a market moving to an extreme like that, certainly after time, the extreme becomes more the norm. It's what happened to the yen. And then how do you get it to move back? You need a catalyst. But anyway, let's talk some more. I want to try a little bit to stay on topic. I'm afraid, for not staying on topic, so I'm going to try and do that. Don't anyone think this is advancing maturity? It's probably not. But if you look at the effect of quantitative easing, which is it's not your fault, it's my fault. I'm the one who gets off topic, believe me. And I enjoy getting off topic because as I talk, things trigger other things, and of course, everything relates, and I always try to make those relationships understandable, both to myself and to the people who are listening. But this is a currency seminar, and so I'm going to try and keep a little bit at least to currencies. If you look at the Australian dollar, I almost said the Belgian franc. I don't know why that is. If you look at the Australian dollar and its reaction to quantitative easing, you can see that by and large, quantitative easing hasn't had a whole lot of effect on the dollar, on the Australian dollar. Right? We look at this here. We see QE. Actually, the Fed started QE1 back here, but because of the extreme move in the dollar relating to, and dollar assets relating to the financial crisis, I'm always reluctant to put any real logic to this move I hear, which takes place in the euro as well, and many other currencies against the dollar, to anything more than the reaction to the extreme overvaluation of the dollar because of the panic in the financial crisis in late 2008 and early 2009. But here we have QE2, which extended from here to here. Here we have QE3, which was the $40 billion a month purchase. And there we have open-ended. That goes back to 2011, open-ended. And now if we go back to 2012, we have the second addition to QE, which makes it $85 billion a month. But the Australian dollar really didn't do very much, so it's clear that from here to here, quantitative easing was not the driver of the Australian dollar. Let's look at the real. Oops, that's the recent real, sorry. Okay, this is the Rupee, going back over 2 years. And you can see also that there hasn't been a tremendous change in the valuation of the relating to the earlier quantitative easing positions. So it doesn't appear, and let's look at the real. Same thing, okay? There's some reduction here, but that's actually going the wrong way, right? Because what you would be looking for is a strengthening of the real, which in this case, because these are quoted against the dollar, would be going down. So it doesn't appear that for those three currencies, the quantitative easing relates directly to the currency. But take a look at the equities. This is the Brazilian Bovesa exchange. And for the period here, you see a reaction to the fall, of course, as everyone else did in all the equities. But here, remember, we have, if you look, you have QE kicking in here, and you have QE kicking in here and here. So it seems that there is an interest in looking for return in the equity markets. Let's take a look at the Sensex. It's a 5-year Sensex. Same thing. It's not a huge run-up. It's certainly nothing like this. But throughout this period here, there's a very high level of interest. We can see it here too, as QE kicks in. Because remember, take a look at the QE. It's the Aussie dollar. We have QE beginning in mid-2011. Okay, so let's take a look here. Where's the... It's easier to do it from over here. Come on, computer. Whoops, hold on. Don't. Okay, there we go. So we'll take a look at the Sensex 5-year. Okay, we have QE kicking in here. So you have it going from 16,000 almost to 20 during that period. The Indian economy is not seeing any, it's seeing reasonable growth, good growth compared to the United States, and compared to the West, but not phenomenal growth, not like the growth of China, plus it's a much smaller economy. Yet you see this phenomenal rise in the Indian Sensex. Let's take a look at the Shanghai Composite. Very, very different story. In this period of QE, the Shanghai Composite is largely falling. What do we have for the, so we have the, just as examples, we have the Brazilian, we're back to this because I have my QE dates on here. So we have the Brazilian and the as examples, and the Sensex, the Bovesa and Sensex rising in this period. We have the Shanghai Composite falling. We have the Aussie largely stable. Now, what changing largely? We're talking about between 1 and 1 here. This is largely, in a great currency term, this is largely stable. This is the move. This is the move here. Come on, computer. This is the move. Excuse me a moment. Okay, there we go. This is the move. This is a move. This is large stability, and this is the move down. So, what do we have? Let's take a look at just for instance, take a look at the Aussie here. Okay, now, where's my China GDP chart? Okay, this is China GDP. This is year over year China. This is the 15-year chart. Now, let me just take a look at the, whoops. I'll show you this in a minute. Okay. So this is the Aussie relating to QE. As we can see, there's not a lot of change here. Let's try another comparison. Where's my Aussie? Hold on a second. Dun, 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 dun. Oh, what we need is the Aussie. Sorry. The Aussie 5-year. Is this the one? No, it's not the right one. Here it is. Sorry. Okay. This is the chart I wanted to show you before. Okay? So we look at the QE effect, and we can see there's not a great deal of effect here. This is the release on April 14th of Chinese GDP year-to-year first quarter. Anywhere in the world, they look at this and say 7.7%. Whoa, this is great. But we all know that the issue in China is not, it's not, as with so many other everything else in economics, it's not the absolute, it's the comparative. The prior growth had been 7.8. The expectation was 8. Remember, this is April 14th. You can see the date right here. This is a Bloomberg page. Came in at 7.7. At what date did the Aussie turn? No guesses for what date that is right there. It's April 15th. That's the date that the Chinese GDP was reported. Huge fall that day, about 4 figures if I remember. So here we're looking at the Aussie. Compare it with the QE comparison, okay? These are the two relevant comparisons for the Australian dollar. Hold on, let me move these aside. Comparing which has the effect on the Australian dollar. And the answer is, and that's what I'm trying to do here, is self-evident. The Chinese economy is more important to the Australian economy and to the health of the Australian dollar than anything else in the world. And the proof is in these charts. Now, I don't know. I can make the charts bigger, okay, but I can't fit them on one screen. This is, and we're talking about this one right here, so let's talk about this one right here, okay? This is the Australian dollar and the comparison between the Chinese economy and what's reported. Remember, I mean, all that happened on that date. No. No, I don't think today's was that much of a game changer. The game changer was back here. Remember how markets work. We all know this. We're all traders, or we're traders, or hope to be traders. Except for the people at FX Street. I don't think they're trading. He who jumps first jumps the farthest. So the thing about foreign exchange is, and in any other trading market, is if a market's going to trend, he who gets in first makes the biggest move. So that's why for what appears to be a small item, you get enormous effect, and that's what's happened here. This is the first time that the markets were forced to entertain the idea that the Chinese economy is not going to grow the way it has in the past. The Chinese economy doesn't grow as it did in the past. Then the economic effect on a resource-dominated economy, like the Australians, is that everything becomes a little bit tighter. Everything becomes a little less buoyant. That's all you need to know for this kind of effect to happen. I mean, compare the difference in, the angle of this trend was well established by this point right here. Now, I should have checked in here. I'm sure there were some other figures in here relating to China that helped this along. But this clearly is the big move. Get a few confirmation. You get that here, and then through here, you got other Chinese statistics. If I remember, you got some of the ISM numbers, some of the industrial production numbers, which confirm that, and then you continue. But this trend was well established long before Mr. Bernanke said anything. His first hint about tapering was on May 22nd, when he said that perhaps the economy continues to improve as we expect. The Fed could begin tapering off its bond purchases. It's not stopping them, not contracting for God's sakes, but it will have its contractionary effect by the end of the year. My own view on Mr. Bernanke is this. I'm actually going to write a column on this week. Part of it is that I think the Fed has the Australia is weakening for the U.S. vis-a-vis the New Zealand dollar because the Australian economy is in my mind, more dependent on China than the New Zealand economy is, because there's a huge mining sector in Australia, which is basically the mining feeder for the Chinese economy. That's not true in New Zealand. Just as a side note, you all know that that's true. There are many jokes about that, none of which I will repeat here because they're all, as it used to be said, off color. Although one of my first jobs in foreign exchange with any responsibility was was on the Asian desk at Credit Suisse, and so I dealt with lots of Kiwis. Many of our major customers were in New Zealand at that time, so many of the brokers and my friends in the business from those days were New Zealanders. But I can't repeat any of those jokes. I know that's a cheap way of doing it, but I can't. It's not appropriate. Maud would never let me back on if I repeated any of those jokes. So she's from a very straight-laced country. So the Australian dollar was affected. That's why it's going down. Okay, so let's look at some of these currencies here. Okay, so you can see right here that the effect of the Bernanke note. What I was going to say is that, Mr. Bernanke's people in those positions actually think a good deal about legacies. The quantitative easing program, Mr. Bernanke's guidance of the Fed over the past 8 years. He may very well want to go back to Princeton. I hear it's a lovely place. Over the past 8 years, at this point, I would say, would be viewed very favorably in a historical judgment. Things could have been a whole lot worse. They really could have been. Mr. Bernanke has been right about inflation. There's no inflation despite quantitative easing and all the other things. But Mr. Bernanke is not going to be reappointed, I don't think. Our President, Obama, has made it pretty clear that Mr. Bernanke is not going to be reappointed. my guess, and I think everybody else's guess, is that Mr. Obama is going to appoint an easy money Fed chairman. If Mr. Bernanke does not get the Fed on a roll to reducing its involvement in the economy and reducing its quantitative easing programs while he is chairman, it's a good guess that with a congressional election appearing on the horizon next year, that the Fed chairman will either be chosen or be under a great deal of pressure to keep the loose money going at least until the election. Perhaps a cynical point of view. So Mr. Bernanke, in my mind, would be under pressure of his own to end this policy before it becomes permanent. Speculation on my part. Okay. So here we have the first whiff of the, hold on a second. No, I'll talk about that in a minute. Let me give you historical. Okay. So you can see that in my mind, the Fed policy has had limited effect on the Australian dollar, and the major impact has been the economic story in China. Let's take a look at the Australian dollar. This is the 20-year view of the Australian dollar against the U.S. dollar. The average is 75.84. Okay? Let's take a view at the 30-year. The 30-year it's 75.95. Remarkably consistent. These charts include, as part of the average, the great fall and rise after 2008. Now, I think two things are going on. Let me put the Australian 5-year up. Two things are going on with that. We're close to the end here, so I want to also show you the difference for the real and the rupee. I think two things are going on here. The world economy is not static, obviously. It's a great statement. If you pause after a statement that is very obvious, it makes it seem more profound, but it's not. So there is, I think, a serious change brought about for the Australians, primarily by China, in its position in the world economy. Over time, the strength of the economy and the strength of the currency is related to the strength of the economy. So, I do not think that you're going to get the Australian dollar resuming its historical relationship with the U.S. dollar. The historical relationship, the reversion to mean, would bring the Australian dollar someplace back below 0.8. But that does not take into account the permanent improvement and growth in the U.S., in the Australian economy, brought about by the growth of China. Now, I can't, with this kind of volatility that we've seen since 2008 in the Australian dollar, I mean, this is a lot of movement here. We've got from almost 1 down to 6 and then back up to historical highs. This is currency trading paradise. But when this all plays out, I think we will end up with an Australian dollar considerably stronger vis-a-vis the U.S. dollar and its other trading partners than it has been historically because of its improved relationship and position vis-a-vis the Chinese economy. Okay, let's look at the rupee. Wait a minute. Let me put the charts up that have the. Okay, I know we're getting to the end here, so I want to cover these as well. And this is the largest difference, and I apologize for the fact that maybe you can't see the charts quite as well as I'd like you to, but I do want to get two charts onto the screen here, both the real and the Indian rupee here. Okay. Now these also have on the charts the three factors that I had on the Australian dollar chart. The background to all three of these currencies and the economies is the same, economically, financially. It's the search for return from the owners of capital. The owners of capital largely, not completely of course, but largely, if you say recent China data, no, it's not been great. The Chinese are slowing, and nobody knows quite how much. The government is in favor of it. I think there is the new government. I think that's why they were chosen. But don't forget, the old government's chosen by the new government's chosen by the old government in China. They don't have elections, so the new government in China would not be the new government if the old government did not approve of their view of the economy. The Chinese have been talking forever about moving their economy away from sort of a mercantilist, export-driven economy to a consumption-driven economy, or at least moving it more along that path. They've very much not been successful at that. In fact, I believe the domestic consumption has gone down, largely because of, I'm not going to comment on that. But the Chinese economy will continue to, I think, the growth rate will go down. But we're getting to the end here. It's 58, so let me cover this. Look at the difference in these charts. India and Brazil. The first note up here is that April 15th Chinese GDP report had essentially no effect on either currency. Very different than the Australian effect. Now look at the other two notes. Mr. Bernanke's May 22nd comment. I'll answer your question in a second, okay? Let me just cover this point. The dramatic rise in both of these currencies. Remember, where we have been, take a look at this. Take a look at the Indian rupee, right? The Indian rupee had essentially been trading below 56 to the dollar all year, right? You can see this right here. It doesn't break through until after the Bernanke quote on the 2nd. That's not entirely true of the Brazilian real, but still, if you look at the greatest amount of trading, it's below 2.05. Is that 2.05? No, 2.05 to the dollar. It's after Bernanke's comment that shoots up. The difference between these two currencies and their economies is that the amount, one is the size, of course, but the second is that these currencies are viewed as let's put it this way, we're the recipient of many hot money flows into those currencies and the economies, into the stock markets. That is the type of investment, speculative investment, that is directly affected by a change in U.S. interest rates. If U.S. interest rates are going to go up, and they are, then your return, because remember, take a look at this. You can just see from the charts that these are hugely risky endeavors. And as soon as the risk parameters change, everybody dumps. Everybody gets out. These are speculative moves in the currencies because the exchange parameters vis-a-vis the U.S. interest rates have changed. And everybody gets out. This is a very different scenario than the scenario of the Australian dollar. The Australian dollar moved based on a perception of an economic relationship with a bigger economy to which it supplies raw materials, the Chinese. No, the view of the world economy hasn't really changed since May. The view of the individual economies here, I mean, don't forget, we're talking about since May. That's 3 months. The view of the individual economies here hasn't changed tremendously. There's been no precipitating economic information involved here. Now, there's some, of course, but nothing as dramatic as what we saw out of China. But what is different here is the financial view of the participants in the economy. If you want to participate in the world economy, if you want to get FDI, foreign direct investment, if you want the money coming into your country, you need to have a relatively open economy. Unless, of course, you're the Chinese where you control everything. But the Chinese chart a different path to the world economy. And because of their size, and also because of perception, they have been able to run their own, largely because of size. They have been able to run their economy and its relationship with the rest of the world differently than the Brazilians and the Indians have been able to do so. Okay, let me just answer these questions here. So, this is the main difference between the currencies that we're talking about here. These two have been the result of financial speculation, if you will, in the currencies and in the stock markets. The Australian currency is largely a result of changes in economic perceptions with its relationship. These are two very different things. I hope I've illustrated my point well there. Okay. Hold on, let me answer one of these questions. I thank you all for coming. Okay. Okay, this is my point about the Australian. We're talking there are two different time frames here. The Australian dollar is currently weakening against the U.S. dollar because the participation of the Australian economy in the Chinese economy will go down as the Australian mining companies won't make as much money if the Chinese are not buying as much iron ore. But long term, the Chinese economy is not going away. The Australian economy will be stronger and larger than it has been in the past. So although and the Chinese economy as well. And although the current immediate, since April, decline in the Australian dollar versus the U.S. is related to a reduction in Chinese growth, I feel that it will never return to the historical levels against the U.S. dollar, which are generally below 0.8, because of its enhanced long-term potential. I mean, 20 years ago, when I was trading, believe me, nobody was paying any attention to the Chinese economy. I was there in 86 and 87, and it was absolutely fascinating. There was nothing in the stores. Shanghai, I've told people this before. Shanghai the Bund in Shanghai hadn't changed since the 30s. It was absolutely fascinating. Hey, what's going on with this? So anyway, that's the difference. We're talking about time frames here. Okay, I hope we kept more to the topic. I think we did. I hope this was very interesting. I'll be doing another one next month, but I'm not sure what the date is because I am taking some vacation next month. Going to take my 5-year-old twins, to the beach as much as possible. Kids don't stay young for very long. Once again, thank you all for coming. I hope this has been instructive. I thank Maud Gilson and the people at FX Street for this opportunity. It is much appreciated. I hope everyone has a lovely day, evening, and enjoy the beach if you're near the beach. Take care, everyone.